Hey, everybody. It is good to be here today. It's Wednesday, which means it's time for managing an options portfolio. My name's Brent Moores, and today I want to talk to you about kind of two key concepts regarding options trades. Doesn't matter the type of trade, two important concepts. I'm talking about these partially in response to your feedback. We have these surveys and you give us some feedback and questions about these two items that I'm going to be talking about, namely probabilities and liquidity. So we're going to get to that in just a minute, but let me just mention a couple things before we get there. Number one, I'm joined alongside Ben Watson, who's helping me out in the chat. Make sure, by the way, if you are interested in index options, to check out Ben's webcast. It occurs immediately preceding this webcast on Wednesdays. It's recorded, so if you missed today's, no problem. You can hit up the recording there. So Ben is very experienced in the market. I've been working with Ben for over 20 years now, and I've learned a lot from him. So make sure you do the same and follow Ben. You can follow us on X at Brent Moore CS, at Ben Watson CS. Also, remember, options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only. It's not an individual recommendation of any security, strategy, or chart type, or chart pattern. Schwab does not recommend the use of technical analysis as sole means of investment research. The paper money software application is for educational purposes only. And I may not factor in commissions or fees in the trades we look at. No matter, it's something you need to consider, though, something that you need to think about, because they're real, but it's just kind of for sake of simplicity when we talk about returns on that. All investing involves risk, including the potential loss of principals. And let's see, the paper money virtual trading application will not assign a short option early, which is different than a real account. Past performance of any security or strategy does not guarantee future results. Okay, here's what we're going to do. Let's head on over. This is the S&P 500. You can see we're up a little bit today, a little bit off the high of the day, off of where we opened for today. But in general, the trend has been just kind of trucking along, and that's where we are. But, the question often comes up as to probabilities. We talk about probabilities a fair amount in this class. If you watch Ben will talk about probabilities. In fact, Ben does, he's on these workshops out there, and when he talks about options, he talks about probabilities. We'll talk about probability of being in the money or probability of out of the money. How are those probabilities calculated? Well, that's something I want to start off with, and I want to just kind of give you a little analogy here of a, let's say we have a pond here, okay? This is my pond, okay? And that's my pond of water. And we put a little duck in that pond. I don't know, I would do my little yellow ducky in yellow, but I don't know if that's going to show up real well. We'll see. Okay. Yeah, here's my duck. Okay. So I know that doesn't look anything like a duck, but we're going to call that the duck. We put that little duck there in the pond. And then we say, what are the odds that this duck gets beyond this level, this area, in a given amount of time? What are the factors that go into that? Well, number one is, where's the duck starting out? We'll call that point A, okay? And where's the line and their relationship to one another, okay? The odds of the duck getting past the line partially depend on where the line is compared to the duck. If we started the line right here, the odds would be very high. If we started the line over here, the odds would be much lower. Okay, so the closer we are to the point we're talking about, that is, the odds are going to be greater than there. Okay, greater than that. So those are two typical things. Now, also consider this. How much time are we going to allow it? If we put the duck over here and we look back 5 minutes later, the odds of it going past point B may be very slim. But if we give it more time, say we give it 3 hours, the odds are greater. Okay, so there's another thing. What else is there? Maybe how choppy the water is. And the more movement in the market, if it's just a very calm, placid pond, okay, then the duck may not move, may not be very likely to move as far as it would be if that waters were a little bit more choppy. So you can probably see where I'm going with this. If we call point A, where the duck is the current stock price, okay, so that's the current stock price, and point B as maybe a particular strike price, okay, as a particular strike price, that's where we're talking about the probabilities of it going. But I mentioned there's a time element in there. Well, options have a time element. The more time you give it, it's going to give you the higher probability of the stock getting to that particular point there. And what about that choppiness of the water? Well, that's what we're going to call the implied volatility here. And the more choppy or more volatile the stock, then the more odds, the higher the odds, the stock is going to go to a certain level there. Okay, so that's just kind of an analogy on how these probabilities are calculated. These are the biggest factors in coming up with those probabilities there. Now, a big thing there is like implied volatility, because, you know, time till expiration, that's kind of easy to conceptualize. Strike price, it's just whatever strike we're looking at or level we're looking at. Stock price, that's easy enough. What's this implied volatility thing? It's how much the market is anticipating in terms of movement for that particular option. And it differs by every different option there. But what drives that implied volatility? Well, market sentiment drives implied volatility. Supply and demand drives implied volatility. Or do we have upcoming earnings or the economic milieu, so to speak, will drive that implied volatility there. And so these are all factors that come in when we start talking about where are the probabilities here. If I go to that trade tab, I can go over here and I can look at these column headers, and you can click on, let me just click on this one. I can go to option theoreticals in Greeks. I can go to probability of it being in the money, probability of it being out of the money, and these two are going to basically add up to 100%. It's either in the money or out of the money at expiration. Okay. Probability of touching. If we go back to the duck analogy, let me go back to that pond here. Okay. Here's our duck, our starting point. I'm just going to put an X here, and we say, here's the point whether it's going to go above that. If we just say a particular point in time, the odds of the duck going past that are higher, perhaps, than at some point, than it staying beyond there. It's possible the duck goes here and then comes up back and ends up floating back this way. Well, this would be analogous to the probability of touching. The probability of touching is going to be higher in this than the probability of being in the money at a particular level. And so you can judge the probability of touching, you can judge that probability of the money. So these probabilities are calculated by implied volatilities. So there's a math. I'm not going to get... You can go and Google the math formulas on there. They're kind of the traditional probability equation that we talk about that goes into factoring option prices. The groundbreaking one was called the Black-Scholes model. you can, I don't even know how to spell Shoals. I got to remember I forgot how to play Shoals model. I'm misspelling that. I don't remember. That's that. But really, a lot of that, the major factors, stock price, strike price, and implied volatilities there are the things that are going to go into that. So you're welcome to Google the mathematical formulas on that. You can do that. We're not going to get into that right now. But that's a key factor when we're considering options positions. And we'll look at that in just a little bit, factoring some of those probabilities in there. But something to keep in mind, doesn't matter the type of trade, your probabilities. Number two, liquidity. When we talk about liquidity, we're talking about the ability to get in and out of a security, maybe a stock or an option, okay? A stock or an option that is without getting the expected price for that, getting a fair price for that. So that's when we talk about liquidity. When we talk about liquidity, there are different measures of liquidity, and we're going to go into those in just a little bit. And let me just answer a couple questions, going back to probability. Okay, so Ben, it says, I'm into Black-Scholes, the model I was talking about. That was kind of the original. There's different models now, so you can go to different models and see probabilities from different models. And Gina says, what's considered high or low probabilities? Well, part of it depends on the type of stock. There's some stocks out there, for example, let's say Tesla, okay? So here's Tesla, and I'm just going to click on implied volatility, and you can see where implied volatility is on this. Right now, average implied volatilities on it are about 50%. Well, let's compare that to, say, Coke, okay? Coke implied volatilities right now are around 18%. So what is high for Coke is very different for, Coke spiked up, way up to almost 40% back here. What's high for Coke is different than what is for Tesla. Those stocks that tend to move more are going to have higher implied volatilities on average. So if I see a stock with an implied volatility below 20, in general, I'd probably say that's a fairly low implied volatility, okay, like Coke here. But compare it to its own history. Same thing with Tesla, or more of a high-flying, more volatile stock. If I see something with an implied volatility above 40, I'd say that's a high implied volatility, but really you need to compare it to its own history there. Okay? So let's go back and let's talk about kind of looking at liquidity, because there's different ways we can look at liquidity. We'll consider Coke here for a sec. As I'm looking at liquidity, one thing you can do is you can always look for like open interest and volume. We've added a volume and an open interest level right here. And you can see it listed right here. Here's volume. NA, it means there's no volume on this today. Volume tells you how many contracts for options are traded today. Okay. Open interest is the number of outstanding contracts there that are out there. So volume resets day to day as the number of shares go in each day. Okay. Now, open interest, as long as the contract has been open and it hasn't been closed yet, okay, then it's going to add. That's going to be cumulative. So generally, you're going to see open interest go up. It could go down if contracts, let's say a contract gets exercised early or something like that, that it may go down. But those are some measures that sometimes people look at. In general, I do not encourage traders to look as much at volume as other measures. Open interest is certainly something that you can look at. And also look at the difference between the bid price and the ask price. That's what we call the bid-ask spread. Now, when we look at this, let me scroll down to something being near the money. I can look at the difference here. Look, there's a 4-cent difference right now in the bid price and the ask price. Is that big or small? Well, 4 cents isn't very much. But part of it depends on the option or in the stock we're looking at. Let me just do this as an example. Let me pull up Netflix for a sec, okay? Here's Netflix. Netflix is a $1,200 stock, okay? The options, therefore, are very expensive. Let me scroll down to being at the money, okay? Now, are we going to see a 4 or 5 cent difference on our bid-ask spread on Netflix? No. So I would consider it maybe more in terms of percentage here between the bid price and the ask price than just the pure dollar amount. Okay? So what percentages? Generally, what I'd say is ideally, we're looking for something 5% or less between the bid price and the ask price. Okay, that's great. And if it gets to be above 10%, we're probably going to say, no, I'm not interested in that. Now let's look at something that's not a super low or not super high, something that's a little bit more of a normal priced type stock. Let's go to, let's see, that's still a little high. Let's go to, well, Tesla was lower, wasn't it? Tesla's $340, okay? So let's look at that percentages here as we look at Tesla. Again, I have too many strikes. But we can look here and we can see, well, what's the percentage? Look, there's only like a 10-cent difference here on this. Well, a 10-cent difference on a 50-cent stock option would be a lot, but here, that's a very liquid stock. We can look at other companies. Let's look at another company. Here's NEE, NextEra Energy. Okay, here's NextEra Energy. Let's go down and look. I don't need this many strikes. Okay, let's judge this by it's about 10 cents on a $3 option. That's okay. Look at the difference when we go to weekly options, though. A lot of times when we go to weekly options, the spread is bigger. It's larger, okay? And this one isn't terrible, but it's about 30 cents. Using our criteria that we mentioned before, that's actually kind of on the high end of things, which is why often we'll go to those monthly contracts instead of those weekly contracts, okay? Now, look at the open interest on this. Fairly high here. This is, we're in the thousands. Most traders would say that's a positive sign. Again, I'm not going to worry about the volume here, but I'm going to worry about that open interest. A few hundred, probably fine. Assuming you're not doing hundreds of contracts, which open interest of 5, maybe a little thin there, and that may be kind of a red flag. You'll generally see a correlation between open interest and how much open interest is and those spreads. Here we have pretty tight bid-ask spreads. Here we have open interest that's fairly high there, okay? All right, so let's say we want to combine these. We want to find companies with fairly high liquidity. One thing I would maybe suggest to you is this, is you can create a scan, go to the scan tab, and create a scan for more liquid type stocks that are more likely to have more liquid options. And keep in mind, there is a difference. A stock can look fairly liquid. A stock could be trading, 5 million shares a day and have a penny difference between its bid price and ask price and still have more illiquid options. But the starting point is finding stocks that are more likely to have liquid options here. So we can do this. We can create a scan for this. And so this is what we're going to do. I'm just going to start in a standard scan here on this. And let me just I'm going to get rid of our initial screens there. I'm going to go to all stocks, and I'm just going to start with S&P 500 stocks, okay? So I'm going to go to public, S&P 500. We got S&P 500 stocks. And what I'm going to do is I'm going to intersect this with, on the public list, something called penny increment options. Okay. What are penny increment options? Well, penny increment options are this. When you look at the option price, stick with NEE here for a sec. Notice sometimes with some stocks or some options, you're going to find they only end in zeros. Okay. But look at this. This ends in 53 cents, ends in 48 cents. In other words, this can go up by a penny at a time if it wants to. Okay. This may flip from 48 cents to 49 cents. But if you look at some companies, it will only go from, say, 50 cents up to 60 cents. Okay. So that's what we're talking about when we're talking about penny increment options. You're able to, the increments here can go. They don't always jump from a penny to one penny to the next, but they can. That's a penny increment option. And that's a good starting point, at least. It's not the final point, but it's a good starting point for more liquid type options. Okay, so let me go back to that scan. I'm looking at the S&P 500. I'm intersecting with penny increment options. Now, what I'm going to do is I'm going to add a couple filters here. You can just add a stock filter, and we can just say, hey, I'm going to look at that stock price. And you can look at the ask price. You can look at the closing price. Doesn't matter. And I'm just going to say I'm going to look at least $20 per share. Okay. Generally, higher price stocks that aren't really low price stocks, are likely to have more liquidity. This is, to be honest, probably kind of unnecessary in this scan, because if we're looking at S&P 500 stocks with penny increment options, they're probably going to be $20 a share anyway there. But just in case you modify this scan ever, you want to do some variation of this, just realize that's something that some people will look at that. Okay. All right. Now, let's go and look. Now, RTR said volume is only 11 on that strike. Remember what I just said. We're not concerned about the volume. We're concerned more about the open interest. We're concerned about the bid-ask spread. Don't worry about the volume here, okay? Volume on an individual option can be zero, yet it could still have quite a bit of liquidity there for the reasons I just went through. Okay, now let's go through and look at, I'm going to add another factor in there. And I'm going to go and I'm going to say, I was just talking about that volume on options and how it doesn't matter. However, one thing that is going to be a good indication is volume on the underlying stock. If you find a stock that, let's say it's trading 250,000 shares a day, okay, that may sound like a lot, but if it's averaging 250,000 shares a day, it's much less likely to have good options volume or options liquidity there, okay? So what I'm going to do is I'm going to add in stock volume as a parameter. Now to do this, I'm going to do an average volume. Now I could go here to add filter, add stock, and go, there is something here that says volume. That's today's volume. I want the average volume. So what I'm going to do here is instead, I'm going to go to a study filter. Now, study filters are only going to work on your live platform, not on Paper Money. You're going to click on study. You're going to go here, and we're going to go to volume, and I'm going to go to average volume, and I'm going to say it's greater than 10 million shares. Okay, I'm going to add another zero there. I got to make sure I got my zeros right. That's 10 million shares a day. And now when I scan this, instead of the 500 stocks that would be seen with the S&P 500, it's coming up with 50 results here. So we just took the top 10% of most liquid stocks here. Now these are the underlying stocks. We may still find some options. Okay, we may still find some options that aren't liquid. So we're still going to check that out. But this is I think, a decent starting point here. Now, if you do this, and then what you can do is let me get rid of my drawing tool. And then what you can do is you can save the scan. And you can use this in the future. Once you save the scan, it's going to be available as a watch list. Okay? So to save the scan, you go to the middle one of these little 3-line sandwich menus here. Click on that, and you can save that scan query. Okay? So we do that, and it brings it up on another screen, and I could do liquid stocks or whatever. Okay? So, and then you can save that. Now, I already have that scan saved, so I'm not going to save it again. But that's how you do that. Okay. Now, this scan here, and I'll share this scan with you. Okay. Let me so, and by the way, if you want to come back and load it, you just go to Load Scan Query. And under your personal scans, it'll be there. And we did this one, okay? So penny increment options, S&P 500. Let me share this scan for you, okay? I'll share this scan with you. Share. Boom. I'm going to put that in the chat, okay? I'm sharing that. And this is not guaranteed for accuracy or timing, these shared scans here. And for those of you who are watching on a recording, let me just do this and add a scratch pad. I'll just put it over here, and you can copy this down if you want. Here's the scan there, okay? Exclamation point A in X5AYD9. It is case sensitive though. Okay, so make sure you get the case there. I'll let you guys should be able to see that. So there's that scan if you want. If you're watching on recording, you can pause that and do that right now. Okay, now, but here's the thing. Here's the cool thing about this. Once you've saved the scan, what you can do is you can then go to your watch list. Go to a watch list. Click on your watch list, and it's going to show up under your personal watch lists. And you can just go here, and when you want to look at it, you can go here. Okay, so there's that watch list. If I ever want to look for stocks that are a possibility for option trades. Now, doesn't mean any individual option trade we look at is going to be appropriate, of course, but this is a starting point. Now, a lot of times I get the question, I come up with examples in these webcasts I do, in these options webcasts. Where'd you find that? Usually I'm looking at a watch list like that and going through and looking at these. Now, let me take you one step further on this. What's kind of cool about this is this. Again, let me reset this, start from scratch here, okay? Let's say you want to combine your scans, and you will find, well, I don't just want liquid options. I want bullish stocks, for example, with liquid options. So you can take another scan. I'm going to click here. I'm going to load my scan query. And let's just take, I'm going to do a, let's see. Actually, let me go up here. 2050 SMA uptrend. That means my 20 and my 50-day moving average is uptrending there, okay? So, and if you're interested, I'm not going to take the time to build this scan with you, but heck, I'll share the scan with you if you're interested. And so we'll share this one as well. I'll put that in the chat. Again, not guaranteed for accuracy or timing, but I'll put this down here as well as my second line item. There we go, exclamation point XKP2FLSY. It is case sensitive, so you got to capitalize that S there. Okay, so there's this scan. This is just looking for stocks where the moving averages of the 20-day and the 50-day are going up. But let's say, hey, this is great, but when I look at these results, I'm getting 40 results, and some of these aren't very liquid stocks, okay? Now, it's probably not too bad because it's S&P 100, but here's what I can do. I can then intersect with my other scan, which was my liquid stocks scan. And now when I scan it, I've got 15. So sometimes you'll hear me refer to kind of layering scans together. We just did that. We took a scan and we intersected it with this other scan that we created. Now, that I just did two particular scans. Look at your own scans that you've saved, if you've saved some, and consider you can intersect the two together and get the best of both worlds. Very often, though, I will tell you, when I'm looking for potential trades, what I will do is I'll start with some idea, and then I'll say, I want those more liquid. So I'll throw that scan in there, an additional scan in there. So I take my other scan and I just make it a more liquid type scan. Okay. So there we go. Let's move on from here. Okay. So we've run a scan. Let me just bring this up here. Okay. And we have the results of that scan. Now, what you can then do is you can then go through and look at these and decide, which ones you're going to, you want to look at. Now, you still need to look at the individual stock. And some of these, there's still some earnings out there coming up, okay? NVIDIA still has earnings coming up. Cisco has earnings coming up. Walmart has earnings coming up. So we'll go down. We got Palantir, Meta, Microsoft. Those don't have earnings, okay? So let's just kind of look at them. PLTR, okay? And let me go back to my kind of traditional graph. And we've got a nice uptrend, 20-day moving up, 50-day moving up. That certainly, from a trend perspective, looks reasonable. Here's Meta, kind of same deal, above our uptrending moving average. And we for a starting point at least, we think we're going under the assumption that this is liquid. Now, you could probably guess that Meta, big company, is fairly liquid anyway. But, when you do this and you scroll down the list, and maybe there's a company you don't, this particular scan is giving you probably all companies that you're familiar with, but maybe there's a symbol on there. At least it's a starting point. Maybe when we were looking at NEE earlier, maybe you weren't familiar with NEE, Nextera. And that didn't happen to come up in this scan, but that gives you a good insight here. Okay, so we got our stock. I'm going to do a look at maybe a bullish trade here. Okay, so we want to make sure we have liquid options, and we're going to go with a probability-based trade. And I'm just going to do a simple trade today on this. I'm just going to do, say, a short put vertical, okay? Pretty basic trade. We're going to sell a put, and we're going to buy a put. I put LP for long put, short put, higher strike, long put, lower strike. We want the stock to stay above, hopefully, both those strikes, okay? That's what we want. Well, what are the probabilities we can work with on that? Well, let's do it. Let's go out and let's look at our option possibilities. Here is Meta, okay? Here is Meta, and we can go and remember, more liquid options you're probably more likely to find the more liquid options on the monthly contracts. Those are the ones in white here. But if you go to the weekly contracts, it kind of depends on the stock. Meta is a more liquid type stock. We still have several hundred open interest on most of these here, and we'll look at the put side of things. And let's look at probability as well. Let me get a few more strikes on here. We'll just do 14 strikes. And what I'm going to do is I'm not going to worry about that volume, so I'm going to just change that, and I'm going to go probability in the money. Okay, probability in the money. And very typically on these, what we'll do is we'll see 30, we'll look at kind of in this range. It's not an absolute. Sometimes you'll see me go outside this range often. On the short strike, often we'll look in the 30 to 35% probability there. Okay? So Well, two of these fit the bill here on this. So what I'm going to do is I'm going to go to this one that's about 35%. And I'm going to look here and we're going to double check our bid-ask spread, about 25 cents on a $13 option. 25 cents on a $13. That's not bad. That's fairly liquid. You can see we have a couple hundred in the open interest category. Not terrible. I'm going to look to sell the 760 and buy the 755. Now, I'm only going to do that if 760 makes sense to me as a strike price. Does 760, let me just draw a line right here. 760 is where the strike price is that we're talking about there. Okay? Right there. Does that seem, yeah, that seems like a support level. That seems reasonable there. And so let's do it. Let's just throw that trade in there, 760. I'm going to just click down on the bid price of that 760. We're selling that one. I'm going to do a control click on the ask price of that. That creates my spread. Here you can see my credit on that, my potential credit. We haven't filled yet. We don't know exactly what it's going to be. You can work out your reward to risk ratio. Here's your max loss divided by max gain. So 152 divided by 348. About 43, 44% reward to risk ratio, which is fairly standard on a short put vertical with a probability of being in the money around 35%. So what I'm going to do is I'm going to put this in our short vertical bucket there, and we're going to send that. Okay. So we just sent that. It's thinking. We'll see if that fills. We'll let that run just a little bit. And there we go. There's the trade. Okay, now, before I run out of time, though, and time is quickly dwindling on me, I do want to talk about some trade management here. One thing I want to talk about is this. On AMD, here's AMD. I've got a short put on AMD. Okay. Short put on AMD. And let me just address questions. 35% implied volatility. That was not 35% implied volatility. That was 35% probability being in the money. 35% probability in the money. Okay. Make sure you got those different. In other words, if there's a 35% probability in the money, there's a 65% probability it's out of the money, which is what we want. Okay. We want it to be out of the money. So 65% out of the money, 35% in the money. If you didn't figure that out, add the 35 and the 65, you end up with around 100% there. So there we go. All right. Now, this is a short put. Now, a short put, remember, it's an agreement to buy the stock, okay, at our strike. 172 strike. The stock's at 184. Now, I put a note on this, and the reason I put the note is because sometimes I forget on this. Note is wheel strategy. We talked about a wheel strategy in the past, and the wheel strategy is basically this. We're doing a put with the idea of we're likely to buy the stock. And if we buy the stock, great, then we'll look to sell a covered call on that stock. Okay. In this case, we did this with the idea, maybe we'll buy the stock. We sold it for $650 up front, but it's looking like we're probably not going to be buying that stock here on this iteration here. My mark right now, I only got 30 cents left. 655 was the initial trade price. 30 cents left. Now, I can just let this expire and this is just going to go away, assuming the stock stays above our strike price. Or what I can do on this trade in terms of trade management is say, look, I can hold this through the rest of the week. I'm only going to get $30 more on this trade here if I do so. But maybe I'll look to roll this out to a new one. So what I'm going to do here is I'm going to look to roll this trade out. And remember, rolling doesn't save you from commissions. You got to pay commissions to buy this one back and then sell a new one. But that's what I'm going to do. It begs the question, though. When you're doing rolls, and I don't care whether this is wheel strategy, short puts, or some other type of trade, when you roll a strategy, let's just kind of generalize, what do we roll to? And my answer is roll to the contract as if you didn't even have this prior trade. What would, if I were just initiating this as a new wheel strategy or as a new whatever, calendar spread or whatever, what contract would I look to buy? And that's what we're going to do here. So I'm going to go to AMD and I'm going to look and see what we got here. Now, I actually have I'm on Meta. Okay. I have AMD here. And I'm going to go out. It doesn't need to go out too far. I just want to get enough that I can get enough time decay on there. And I'm just going to go out a couple weeks or so. Okay. And we're going to look to our new strike price. What's our new strike price? Well, what would I look to sell now if I'm selling a put? Okay. If I kept the same strike, I very well may not get a reasonable, a premium that I want. So I may end up moving that strike price up. The stock's at 184. Okay. Stock's at 184. And I can go and I could bring in, if I do the 182.50, I could bring in another $600. Or I can go out of the money a little bit more and bring in about $525 by selling this. Okay. So doing that 180. So let me just jot that down. 180, 16, we're going to go 29th of August. And let's go here. Okay. Now, so RTR says, why not just close and reopen further dated? This is exactly what I'm doing, RTR. It's a good question. What's the difference of just exiting this and entering the new one and rolling? There really is no difference. We're just putting it on the same order ticket. Okay, so I could just as easily right click on this, close this order and do the other one, but I want to just kind of demonstrate and talk about the process here. I'm going to right click on this. I'm going to create a rolling order. It's just going to say a calendar there. Okay, this is just doing it on one order ticket. Now, this is the contract I was in, the 172.50. This is the and we're going to go to the 180. We're rolling up to get more premium here. The 180, and we were doing August 29th on that. Okay. And now we're getting about $500 credit on this roll. Okay. And let me just do this and just make sure we get filled on that. I'm going to confirm and send, and I'm going to send that order. And there we go. And now when we look at this, what we'll see is, come on, get rid of this. What we'll see is this one's gone. This one's now in play. And this is still going to be a wheeled strategy. So as soon as, if one of these times we're going to put the stock, and then we'll look to institute a covered call on that. All right. Now, you can worry about timing there. Noodle Brain says could you wait for another time yeah, you can wait. You can wait on this. You don't have to do this today, but I wanted to illustrate and talk about the principle of rolling. Rolling, you're just getting out of the front month or one contract and getting into another contract. But the point is, when you're rolling, roll to the contract that makes most sense. The past trade is done with. Don't worry about the past. The past is the past. Okay? So what did we talk about today, everybody? We talked about probabilities. Okay? We talked about kind of conceptually, we didn't get into the math or anything, but conceptually about what determines the probability of in the money or out of the money. We talked about liquidity and creating a watch list that you can use for your trades as a starting point for your trades of trying to find more liquid options. And then we talked about kind of putting it together. And we also talked about management of rolling trades. I want to thank you for joining me. I want to thank Ben for helping me out in the chat. Always appreciate Ben. Coming up next, we've got trading price patterns. Kevin Horner is teaching that one today. So stay tuned, check that out. In the meantime, everybody have a wonderful day, and we'll see you all same time next week. Bye-bye, everybody.